Welcome to the channel Get Rich. Today we are going to look into how to handle stock market corrections or crashes. So before having a look into that, so if you like this video, please like, share and comment, and if you would like a free email newsletter, please subscribe in the link below. So let's get started. So before going into the some of the tips which I am giving for the stock market corrections or crashes, so let's first have a look at the recent corrections in the Nifty 50. So if you look into the Nifty 50 index, so we recently have about 13% corrections from the recent highs. But if you look into the Nifty small cap 250, so in that case it corrected about 16 to 70% in recent times because of ongoing war and the uncertainties in the US and so on. So it's mainly because of Russia-Ukraine situation. You all know about that. So but let's have a look into that. How can we handle these kind of corrections and crashes? So let's first have a look at the market indicators. So always we have to know what is the current market status. So we have to look into the current market indicators which will guide us where the current market stands at. So if you are looking into the Nifty P ratio, where the Nifty P ratio is, so currently the Nifty P ratio is about 20.89, right about the average or median 20.47. So currently we are sitting in right about the median P. So we are, if you look at the current market status, we are not terribly undervalued or we are not terribly overvalued. So we are just at the median range. So you can look for deals in the market because the median also gives some stocks in a much undervalued situation and some stocks in the overvalued situation. So the Nifty P, so we look at that, so it's in the 20p, so that's fairly valued at the median range. And if you look at the price to book PB for Nifty 50, so in that case it corrected but not to the level of the median. And if you look at the dividend yield, so dividend yield rises to right about the median, which is 1.3. So dividend also came just about the median, so it's not undervalued or it's not overvalued. So two of the three indicators are providing us that the market is trading at the median or the historically median range. So let's have a look at what we can do, or what are the tips I can give you, or what you can do in these corrections, in the times of corrections and crashes. So the first thing, we have to make sure deeply in your mind that corrections are opportunities. Always corrections or crashes are always opportunities. You have to look it that way. So yeah, of course, corrections or crashes pains. If you already hold stock, you will see the losses there. So it's difficult times, but these are the real opportunities. You are going to make a lot of money over the next 3 years or 5 years. So this is very important. So you have to make sure your thinking is like, okay, corrections are opportunities. Whatever the losses I am seeing in my current account, so that's just paper loss, or until you sell, that is not a realized loss. So you have to think it that way. So you have to load the boat up, so load up on stocks in a discounted price, because you can see a lot of discount opportunities at that time. So we have to see, for example, if you see the major US index, which is the S&P 500, so there have been 27 corrections in the S&P 500 since World War II, with an average decline in the index of about 14%. So let's first have a look at the difference between the corrections and the crashes. So as a definition, they provide like 10 to 20% drawdown is a correction. Anything more than 20% is a crash. So whether you are encountering a correction or a crash, it's always there was a correction. So if you just see, it's like 27 corrections in the S&P 500 since World War II, but market always rebounded to a new all-time height. So be it always market will find a reason to say the corrections. Now Russia-Ukraine war, there can be anything else, inflation. So there will be a lot of worries which will make these corrections or crashes. But what we have to do is, for us, okay, let's just have a step back and look at individual companies, quality companies, and if they are doing pretty good, and if they are posting year on year like increasing revenues, increasing net income, and if they are doing well, then the stock price will do well in the long term. So always look at corrections or the opportunities. So you have to load up on stocks in a discounted price. So if you are seeing the product which you want to buy and at a 50%, 60% discount, what you will do, you just go and buy. So yeah, you should also do the same for the stock. So you should load up on stocks in a discounted price. And the second one is we have to overcome our fear and emotions, because if we see 20%, 30%, 40%, 50%, especially if you are invested in small caps or mid caps, then your the pain is going to be much more severe. So in that case, you are going to see 20, 30, 40% correction. So it's natural that we'll encounter some fear and emotions. So you should never act based on fear and emotions. We should always act based on the facts and fundamental data. So that's a key thing. So we always have to overcome our fear and emotions, and then we have to think and act rationally based on facts and fundamental data, not just because we are fearful, and we are panic, so don't sell any of our stocks. So in these times, do more and more stock analysis. Whichever company you own, do fundamental analysis, what are their results or what are their guidance are, and just do more research to make sure you have confidence in that particular stock. So that's very very important. So always the quote, people say, be fearful when others are greedy and be greedy when others are fearful. So this is not the time to panic. So if you are having a correction or crash, this is not the time to panic, and this is the time to buy if you have some money on the sidelines, or if you're having your monthly income. Yeah, you can allocate, you can buy stocks at a much cheaper price. So smart investors always does this. They overcome their fear and emotions, and they see things rationally just the way as it is, because market always puts it at a very greedy situation or a fearful situation. You have to be rational and buy stocks in the times of corrections. That's also very very important. And then the next one is, still if you cannot overcome your fear or emotion, so when in doubt, you just zoom out. So what I mean, so if you are in doubt, so let's just take a step back and see from past 20 years what happened. So if you look at the Nifty 50 since 2000, you had several crashes, you have several corrections, but the market always finds a reason to go back to the new all-time high. So there will be always the correction. So market is not going to be smooth. So people say if you invest in index fund, you are going to get a 12% annual return. That's true, but that's not going to be a smooth ride. So it's not going to be every year you are getting 12%, 12%, 12%. No, one year it's going to be 30%, one year it's going to be minus 10%. So that's going to be a volatile one. So you have to live with that. So if you are having still cannot overcome your emotions, so just zoom out and see, okay, what are we doing? So always the market finds a reason to go back, no matter it's a war or it's anything else. So whatever the reason is, the market will always find a reason to come back. So then if you look at the average return, it's 12% for the Nifty 50 for the past 20 years. But then if you see year over year, so you see a lot of green. So it's like 12%, 20% in some months, and some months you are giving negative 17, 30, 20, 25%. So it's like you will get a way more green at some point and way more red at some point. So you have to live with that. So as an average, you are going to do pretty good compared to other investments. And if you look at the previous year, so you see the Nifty did phenomenally well in some years, and they do terribly bad at some years. So you have to understand that the market is volatile in the short time. And then if you look at some of the companies, so if you just zoom out and let's see TCS. So for the past 10 years, they did 30% per annum CAGR, so that's pretty good. If you look at the Asian Paints, 10 years they did 32%. And if you look at the Amazon, Netflix, Apple, they all did phenomenally in the long term. Also, if you look at some of the key, some of the small cap companies, they did way more outperformed than the market index. So it's all, if you look at the past 5 years, 10 years, you're going to do pretty fine. If you look at the 1 year, 6 months, 1 year, 2 year, then that's going to be difficult. But always in the 5 to 10 years, you are going to do phenomenally well. So always, if you want to overcome your fear and emotions, please keep in mind, or always zoom out and see, okay, this chart, it's going to do fine this time as well, because in the past 20 25 times it crashed, corrections, crashes, it came back. So that's going to be the same this time as well, because that's how the market works. And then the next one we have to look at, so we have to analyze more companies. So for example, if the market is, if you are having crashes or corrections, so you have to be more active. So you can follow the market and you can look for steal deals for the different opportunities, because always quality companies trade at a much premium valuation. So at these corrections, you can find a pretty good quality companies at steal deals. So you have to do more and more analysis during these times. More companies, you can look into different companies and you see, okay, what are the opportunities we have and we can take advantage of. Also, you can also do analysis of the company which you already own. So you do more and more research, so that you have confidence in that company, so you don't panic sell that particular company, because you constantly analyze and see, okay, they are doing well, so that means you are not going to panic sell if the price drops. And always have some reserve fund for corrections and crash. If the market is doing phenomenally well, yeah, you can have a certain amount of fund for your reserve fund for this kind of corrections and crash opportunities. So always do that. So always have some kind of fund on the sideline. No, even if it's not much, always have some reserve fund for this time of correction, because this will provide you a lot of opportunities in the next 3-5 years. You are going to do phenomenally well if you pick a right stock during the downtime. And the next one is invest in quality companies. So don't aim for moonshots in penny caps. So invest in fundamentally strong companies, because during this downturn you will get a lot of opportunities, and you can find a lot of quality companies at a pretty discounted valuation. So at that time you have to look into the market, and then you always do have to analyze more quality stocks. And yeah, smart investors always do that. So don't just invest in like penny caps or whatever. So you have to diversify, but then also you have to invest in fundamentally strong companies. I always advise that. For example, if you are investing 10 penny cap stocks which are like shady, or not like you are just betting on that, okay, it's going to go 50 times, 100 times, but then what is the risk to reward ratio? What is the probability that it is going to do 50 or 100x? So if the fundamentally strong companies, if you know, okay, this can do 5 to 10x, but I'm pretty sure, I'm 80 to 90% confident that this company will do 5 to 10x, rather than you have only 5 to 10% conviction that this company is going to do 50 to 100x. I always prefer, okay, this company is fundamentally strong one, and I have 80 to 90% conviction that this company is going to do 5x return in the next 5 to 10 years, or 10x return in the 5 to 10 years. So that's how you have to see the risk to reward ratio. So that's how I always play. I always like to own fundamentally strong companies rather than penny caps. I do have some, if my conviction is high enough, or if my conviction in particular small and very penny cap stocks, if my conviction is strong enough, I do own. But I do diversify. I don't put all my eggs in one basket, or I'm not going to put 70% of my portfolio in penny caps. So you are going to decide your own risk appetite, and then you have to decide and select stocks accordingly. And then here I am listing some of the learnings from the failure stories. So we always look at success stories, but I personally would like to look into success stories and also the failure stories, what we can learn from these kind of stories. So according to me, why most investors lose money in stock market, because if you see a lot of investors in stock market, they are losing money still. So that's very not fortunate. So then the first one, if you look into that, so mainly it's greed and speed. So for greed and speed, what I mean that, so we want money pretty fast. We want to get rich in 1 year or 2 years. So we want to we don't have to see 5 to 10 years and 15 years. If I say, okay, let's wait for 10 years or 15 years, you will get you are 100%, I am 100% confident that you are going to reach 1 crore or 2 crore or 2.5 crore portfolio. And then if I say, okay, there are only 5% or 10% chance that in next 2 years you are going to make 1 or 2 crores. So that's the difference between short term and the long term. So the long term, you will have more probability that you can get rich, and in the short term, if you want to get rich, very relatively smart time, it's going to be probability is very, very less, and it's more likely that you are going to lose money. So don't greedy and have set realistic targets. Don't say you are going to do 40%, 50% annual return and you are going to get rich, but that's not sustainable, because even some of the smartest investors, they are not they cannot do that kind of returns. So set realistic goals and invest in fundamentally strong companies, and always look into risk reward ratio both. So if you are only seeing the reward and this company can go 50x or 25x, So what's the risk of that my investment? What is the probability that I will lose my money in that particular stock? So you have to look into both sides, the risk and the rewards. And the second one is overconfidence. So people have overconfidence and then they say, okay, I'm going to invest in this penny stock. 50% of my portfolio I'm going to invest in this penny stock, or 25% of my portfolio I'm going to invest in this one particular penny stock, and this is going to get me rich. So that's overconfidence. So you have to do your due diligence, you have to do a lot of research, and you have to diversify your assets based on large cap, small cap, mid cap, and also penny cap or micro caps if you have strong conviction. So you have to diversify and then allocate your money accordingly. That's also very, very important. And the third one is due to fear and act by emotion. So act by fear and emotions, don't act by fear and emotions, always act by facts and data. So if you are acting based on fear and emotions and not by facts and data, you will more likely going to lose money, because if you are acting by your emotions, so when the stock markets are going crashing or on corrections, you will feel okay, it's going down, you want to sell. So if you are sell, that's the time to buy. But instead if you are selling, you are not only buying but you are selling your existing holding. That's a terribly bad idea. You are going to lose money, because the single biggest thing in stock market is timing the market. It's always very, very difficult to time a market. You cannot time up perfectly the top and you cannot perfectly time the bottom. It's very, very difficult. No one can do that consistently. So that's something you have to keep in mind. So you can do dollar cost average. If you find still deal, go and buy the stock. If you feel the next 5 to 10 years, if you are going to do phenomenally well on that stock, go and buy it. So you don't wait for the perfect buying time. So timing the market is very, very difficult, and always don't act based on fear and emotions. So please act based on the facts and the data. And the last one is not following a proven system. So which means lack of learning. So you always constantly evolve as an investor. So when you are investing, always you are going to make an error. So nobody is perfect. So nobody can be perfect in investing. Not everyone, even in the smartest of the smartest investors, cannot get 100% of their convictions good. So there is going to be a more winning percentages, there is going to be losing percentages. So you have to constantly learn in this process. You have to follow a proven system, and then you have to learn every time. So every time when you do, okay, if a stock does good, and also analyze, okay, why this stock did good, what did I do? And also if a stock did not do good, so always go and analyze, okay, what did I do wrong, where things get wrong. So you just keep on learning on that particular thing. And the last thing is not thinking failure is a stepping stone. So and also not evolving from their past mistakes. For example, as an investor, you are always, if you are starting out new and if you are investing on your own, for sure you are going to lose money in at least one of the stocks, or most of the stocks initially. So you have to see, okay, I lost my money, I quit, or I'm going out of the stock market. Stock market is not for people like normal people. No, that's not the case. So you have to think like, okay, failure is a stepping stone, I can evolve from these mistakes and I can do good. And then you constantly evolve based on your mistakes, and then, okay, what did I do wrong, this, okay, then I change this, and then I will learn accordingly. So based on that, you can get a lot of money from the stock market. So always evolve from your mistakes. So these are the key learnings from failure stories. And I also have a few points, my personal learnings based on my experience. So the first one is think long term. So short term is very risky. Short term very risky bets result into losing money. So always think of risk versus reward. So think long term, 5 to 10 years, what the stock can do, and don't think like short term. So okay, stocks fall and 20%, 30% in the next 2-3 years. So yeah, think long term. So because short term, it's very, very difficult to time the market and get returns. Think long term, then you're going to do pretty good. And the second one is diversify the assets. So devise a strategy and stick to the plan. So if you are not doing diversification, very concentrated portfolio, that's extremely risky. So at least you should have 10 to 15 stocks. 10 stocks is good, 12, 13 is also good, maximum 15 stocks. So 10 to 15 stocks is something I would do, is a diversification of assets. And devise a strategy. What is your profit taking strategy, or what is your objective? When are you going to take profits? When are you going to buy more? What are your plan? So have a clear plan. So what will I do if stock market corrects 20%? You think in your mind, okay, what will you do if market crashes 20%? What will you do if this happens? What will you do if that happens? Stick to the plan. Have plan A, plan B, plan C, and stick to the plan. Because if the market goes like 100%, 200%, 300%, you might get greedy, and you might don't follow the plan, and you say, oh, okay, this is still going to go up, I'm not going to take profits. That can happen. And even in the fearful market, okay, if it's going to 20, 30%, you're going to say, okay, it can still go 20%, 30%, it can still go down, and not buying stocks. So that's also something, it's very important. So you have to stick to the plan, and you have a proper plan, and you stick to the plan. And the third one is, don't worry about short-term volatility. Have courage to buy more at dips and prepare for the short-term crash. So what do I mean by that? So there is always going to be a short-term volatility. So if you are having a stocks, if you are seeing, okay, very fundamentally strong stocks, it fall down, have courage to buy more at dips. So if it's keep falling 10%, 20%, buy more. If it's falling 30, 40%, if you see the stock is fundamentally strong, the price is falling, buy more. If they are consistently increasing revenue and net income, the stock price is going to increase no matter what. The net income, revenue is increasing, and the company is good, then the stock price is going to go up. So have courage to buy more at dips and prepare for the short-term crash. After you buy stock, it can go down 10%, 20%, 25%. So you have to prepare for that. So it can happen. You have to think that, okay, when I buy a stock, because if you are already buying a stock which is already down 20, 25%, what's the probability that it will not go down more? So it can go down more. So you have to prepare for the short-term crash or short-term corrections. So you have to plan accordingly. So never buy a stock all at once. So do a systematic investment plan, or you have to divide a chunk of how much you want to invest, and how do you want to have your entering strategy to the stock. So that's also very important. And then decide whether you want to do active or passive investing, what suits you or what suits us. So are we willing to put time consistently? Because if you are taking up active investing, you have to put time consistently, day in, day out, every week, every day. At least you have to check the market, you have to check the companies, and at least you have to check every quarterly result of a company, and every quarterly investor presentation, analyst call. So you have to properly follow the company if you're doing active investing. Because not only if you, okay, I bought a stock and then that's it, I'll just sit for 5 to 10 years. So you have to follow the company. For if you are having 10 to 15 stocks, you have to follow 10 to 15 stocks, the quarterly reports, the quarterly results, the investor presentation, analyst call, and so on. And what do you thought of when you invested in the company, and where the company is going, is it still on track? So you have to put time consistently. Time and effort is needed if you are going for active investing. If you are not that kind of person, if you don't have time, and if you don't have interest in doing all these kind of things, go for passive investing, kind of mutual funds, or even active mutual funds, or you can go to passive funds, or you can do index investing. So please select where you want to go, either active or passive investing, because active investing needs much time and effort, and you want to put that, else it's going to be very difficult. And then the last one, so look for the potential opportunity. Have courage to bet big on the opportunities. If you find a steal deal at the very fearful market, if market falls down 30-40%, and if you see a very stealing deal, potential opportunities, have courage to bet big on the opportunities. So because if you are buying, for example, if you are investing only 1,000 rupees or 5,000 rupees, and even if it goes up 10 times or 15 times, so it depends on your net worth. For example, if you have a net worth of, let's say, 10 lakhs, and you are willing to put like 10,000, 15,000 in a stock, which you can see you are 90% certain that this stock is going to do 10x or 15x for the next 5 to 10 years, and you are only investing 5,000 or 10,000 in a stock. What's the point? So if you are investing 10,000, and even if the stock goes 10 times, you're going to get 1 lakh. So that's not a life-changing, or depends on your net worth. So have courage to bet big on the opportunity. So it depends on your risk to reward ratio and your conviction, but then make sure to have courage to bet big on the opportunity. That's when you get rich, because if one of your conviction gets really big, then you have to have a relatively big bet on that opportunity, so that you can get a lot of money, or considerable amount of money, depends on your net worth. So that's also pretty important. So these are my personal learnings, and yeah, that's all for this video. So currently we are facing some corrections based on Russia Ukraine war. I'm sure this is going to yeah, fade away in some time. So yeah, I deeply regret for the people in Ukraine, so they are facing a lot of difficulties, but then this also will pause soon. So and then the market is going to come back again. So there are no worries. So if you find a steal deal, market opportunities, yeah, go out and buy the stock, don't worry about that. So always the market will find a reason to say the corrections and so on. So that's all for today, and thank you for watching. And if you like this video, please like, share and comment. And if you are new to this channel, please subscribe. And if you want a free email newsletter from this channel, please subscribe in the link below. That's all for today, and thank you for watching, and have a nice day. Bye bye.